Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, December the 16th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, and how that comes in to impact the markets with some of my market analysis. And I'm going to do the same thing for you folks out there, but I'm going to layer on top of it these option strategies I'm implementing into my portfolio on any given day based on those assumptions we come up with through that market analysis. But for you folks out there, over my 25 years of trading options, I've streamlined the process to find the optimal strategy for any given assumption. We aren't just picking option strategies out of the hat here, where a bullish assumption means you go out and buy a call. No, what we've done is we've looked at the internals. What creates the best option strategy for any given assumption? And I have a guideline for you folks to follow in order to achieve a higher yield in your portfolio. All right, so without further ado, let's get on with the economic data and see how that's impacting the markets. Today, we've got across the pond, Great Britain coming in with CPI numbers. That came in at 0.3%, expected to be at 0.6%. Core CPI, Consumer Price Index, stripping out food and energy, coming in, sorry, I just lost myself there, 1.1%, expected to be 1.4%. Then we're talking about Great Britain's PPI, which is Producer Price Index. Remember, Producer Price Index is going to be something that we look at before we look at CPI. That's a leading indicator, because if the producer has to pay more for those products, then they're going to try and pass it on to the consumer if they have the ability to. Now, if they can't because of a slowing economy, then that eats into the profits of the company. So really important to take a look at as well. And we got PPI coming in at 0.2%, expected to be 0.4%. They did revise last month's number up by 0.2%, making that headline number almost a wash. And then we come into the PPI output in line with expectations at 0.2%. Now, let's talk about what we've been waiting all week for, is the flash estimates for services PMI and manufacturing PMI. Remember, PMI numbers are Purchasing Managers Index. That's forward looking, because the purchasing manager is looking at the demand for their products and then looking out to buy the raw goods in order to bring into the manufacturing process or the service sector in order to either slow down production or ramp it up based on a higher demand there. So across the pond, we look at, and remember, France, Germany are the leading manufacturing sectors of the European region. Another thing to note is anything above 50 is expansion in the economy. Anything below 50 is contraction. So French services French flash services PMI coming in at 49.2, just slightly below that high watermark, or that above, getting above into positive territory. But one nice thing to see is that it was well above what was expected at 39.9, and a nice revision to last month's number, up 0.8%. Now, if we look at the French manufacturing PMI, that came in at 51, expected to be 50, and nice to see that it went back above 50 into expansion territory. Last month, we got a revision to that number to 49.6, so just slightly below, but we've been seeing that number a little bit below 50, which is showing contraction. Today, we get that number showing expansion in the French manufacturing sector. German manufacturing PMI, flash manufacturing PMI, all of these are the flash. 58.6, expected to be 56.4. No revision to last month's number. Flash services PMI for Germany coming in at 47.7, showing contraction. But hey, it was beating on the headline number, which was 44.1, which was actually looking to pull back from last month's numbers, 46. So a nice beat on that one. Probably a lot of people celebrating as well. Then the rest of the Great Britain area, we got manufacturing PMI, and that came in at 57.3, expected to be 55. Another revision to last month's number, up a few tenths of a percent. German services PMI coming in at 49.9. Just slightly below 50. We were hoping to see that claw back above 50. It was expected to at 50.5. So one of the only numbers to miss here is the Great Britain Services PMI, and not that big of a miss. Nice to note, though, it is better than last month's number of 40. Actually, so last month's number was 45.8, and they revised it up to 47.6. So a nice revision to that one as well, making this headline number not nearly look as bad as what we originally see in that headline number. All right, on to the United States. We got some good, some economic number we got to look at because it is some of the more important economic data to take a look at. Core retail sales coming in at negative 0.9%, expected to be just above the watermark at 0.1%, and a revision to last month's number down from a positive 0.2% to a negative 0.1%. So wet blanket. Wah, wah. I mean, Europe looked like it was doing pretty good, at least on forward guidance, right? These are hindsight numbers here in the United States, but we would surely like to see these numbers coming in a little bit better than that. And remember, core retail sales is going to be stripping out some of the more volatile aspects of that number, like automobiles. Now, if you put back in those automobiles at for the retail sales, coming in at negative 1.1%, expected to be a negative 0.3%, and a downward revision to last month's number from a positive 0.3% to a negative 0.1%. Also, manufacturing, we got our own flash manufacturing numbers here, but we look at the ISM for real guidance, though we will still take a look at it. 56.5, expected to be 55.9. That was for the manufacturing PMI, and for the flash services PMI, 55.3, expected to be 55.7. Bit of a miss there, not too bad, but a upward revision to last month's number by from 57.7 to 58.9. Business inventories, a build of 0.7%. Not a surprise after seeing those retail sales numbers, right? Expected to be 0.6. And then the NAHB, which is the National Association of Home Builders Index, coming in at 86, expected to be 88. Now, if you want to dig into the details of this, well, believe it or not, consumers are getting sticker shock on the price of the homes right now. Also, confidence going forward not looking as good for the consumer as well. A lot of this has to do with the economy starting to slow down. No stimulus. I mean, a lot of you guys, based on that retail sales number here in the United States, you're getting a lump of coal for Christmas. Either that or you're going to be giving a lump of coal. Well, all of those things being said, the stimulus package still not around. We're still playing around with politics here as we start rolling over into 2021. Listen, these people, they're doing very well sitting in their ivory towers, and they are really disconnected from the consumer. And that's starting to show up in these retail sales numbers. It's looking like going forward, it's going to be tough sledding or a tough road to hoe, however you want to say it. All right, finally, crude oil inventories coming in at a drawdown of 3.1 million barrels, expected to be a drawdown of 2.8 million barrels. Now, remember last month's number, we saw that massive build to 15.2. We were talking about, was the decimal place wrong in that number? Well, nope. That number was not even revised one iota. 15.2 million barrels stayed in that inventory number. We did get a bit of a drawdown this month, but 300,000 barrels. All right, not a whole lot to put a whole dent in it. That's why we're seeing a little bit of weakness. I think a lot of people were kind of thinking with this crude oil number, that had to be a mistake. There had to be a revision down, and we did not get that. The market's starting to show some weakness here today as we touch that value area high over here in the crude oil. Finally, right? We got the Fed Fund interest rate decision today, FOMC meeting right now, and we should get that later on today at around, 2:30 Eastern. So keep your eyes out for that. I would expect they're not going to do anything to that interest rate. The real key is to watch the conference afterwards as they release their statements and stuff like that. All right, so crude oil, seeing a little bit of weakness here, as we can see right here in the chart. Not major, but we are near the lows of the day. Came up and tested The value area high lining up right here at $47.97 or $48, we could call it. Again, a pop above that 48, we immediately thinking 50 is a sure thing. I still believe this market needs to come back down and test the point of control, or at least come down to the point of control, because we're seeing this retail sales pulling back. That means manufacturing is likely to start shutting down, or at least pulling back on capacity utilization, right? Meaning capacity utilization, if you have a manufacturing company, you can go 24 hours. Well, you might start cutting back to only having one shift rather than 3 shifts, okay? So that is going to be something that really wanes on the markets as well. If we start seeing COVID ramp up like we're continuing to ramp up like we're seeing right now, that is also going to be something that really slows the economy as more and more shutdowns happen. Yes, the vaccine is coming out. They're producing it as fast as they can. Oh, an interesting thing I thought or read about was that if they shipped out all of these vaccines across the globe, it would take 8,000 747s to distribute all of this vaccine. Now, obviously, and that would be if it was at one time, people, right? I mean, but that's pretty interesting to note how much volume there is going to be in producing this vaccine. All right, so crude oil is weakening still. Another thing we can see over here in gold, up another $6 today. Kind of got back into this flagging area, but we're starting to show some weakness. That is at a top where we continue to see lower highs and lower lows. That is a very bearish signal. I'd like to see that break, because that would mean we're getting a stimulus package. At this point, it doesn't look like it, so gold could go just about anywhere and likely down until we start seeing some of that news. All right, on to the bonds. We can see bonds here up just slightly by 4 ticks. That's unchanged for the most part. Getting really comfortable right here in and around this 173 handle. Well, if people are getting sticker shock right now and higher interest rates, that is a double negative really for the consumer trying to buy a house. Usually what happens is when we see interest rates going up, home prices start going down to reflect those higher interest rates. And right now that is not happening. We're continuing to see home prices go up and interest rates going up as well, which is a double negative, meaning you can't buy that same house you were considering 6 months ago. So that is also going to be waning on the market. And it's winter time. A lot of times in the north, people don't shop for houses. Down here in the south, yes, that is the time where we see the people start to shop in the south for homes as winter really becomes gloomy and or people looking to retire, having a winter place to go to. All of those things really drives the markets here. All right, VIX. Positive territory, just albeit slightly, and that's because we're seeing some weakness across the board here with the Dow Jones Industrial Average off by about 44 ticks. Again, it's not a major sell-off. At the end of the day, we're still above the 9-day simple moving average right here, which is this blue line, just slightly above that. And market just trending sideways. I was expecting to see more of a pullback based on some of the economic data we got here in the United States. Yes, across the pond looks pretty good. Those retail sales numbers right now, November, December, really cutting back, meaning the consumer is really holding back on buying anything, probably because of their negative outlook going forward without a stimulus package and the economy slowing, this revergence of a second round of coronavirus. All of those things weighing on consumers. That's hurting the retailers, and I would have expected this market to start correcting a little bit more than what we're seeing. NASDAQ is slightly in positive territory, but again, close, very close to unchanged on the day. E-mini S&Ps up positive right now, but at any given second, that could be in negative territory, or consider it to be unchanged. Now, let's take a look at the breakdown of the E-mini S&Ps, because it gives a real clear picture as to what the economic data was showing us today. And overnight, pretty flat, right, coming into it. But then we started getting the overseas flash, manufacturing flash service PMIs out of Europe. Whoa, we're doing really good. Wah, wah. retail sales, United States, falling on our face, really, and selling off. Now we're kind of consolidating a little bit, probably waiting for the FOMC to see what they have to say. I would hope that the Fed really starts laying into Congress about not getting a stimulus package, because if you think about it, if eminent domain, right? That's when basically the government comes in and steals your house because they want to build a road or highway or whatever they want to do. Maybe dig a hole, I don't know. But they have to pay you money for your loss of your asset, right? Well, when they're shutting down businesses and shutting down the economy, it is expected that they should probably do the same type of situation. And right now, they're playing politics. They are worried about their own self-interest and what kind of favors can they create and or offer somebody else, you know. And that is a real grind on me, for lack of a better phrase. Anyway, I have a better one. But right now, consolidating at the most part as the markets are trying to digest all this and maybe wait to see what Powell has to say. Having said that, Best Buy just recently put this trade on and decided to blow out of it for a slight profit, because with that retail sales number, if you guys remember, that was pretty bad. And that would have to lead me to believe that Best Buy heading into next year is going to be worse for the wear. And I took the opportunity just to get out of this. If you guys remember, I put this on only 6 days ago. It's trended sideways, so I'm very happy to get out of this for a slight profit. I'd call it a scratch, to be quite honest. And in that, I went into the March. So the March, I had bought the 115 calls in there for $3.85. I basically covered them today and sold them out for $4. You know, at the end of the day, that's a scratch in my book. And then we go on to PENN. You guys remember I have on these PENN covered calls. Well, we got a blast off to 85 today, and I was like looking at this in a couple of days. They're going for 90. Decided to pull out of this trade for, again, very slight profit. Yes, it was a profit nonetheless, but I am also looking to try and roll this out in time to the further duration as well, roll it out and up, right? As this market has been going higher, that gives me that opportunity, so I'm trying to take advantage of that. And with that being said, I had sold the Dees 90 calls in there for $1.02. I basically got out of those for 80 cents today. Yes, that I'm going to look at as not a scratch, but 20-cent profit, right? Lowering my overall basis continuously on this trade, as we have been very mechanical with it throughout time, lowering that overall cost basis. Now what I've done is gone into the January, which is right here in this section right here, and look to sell the 110 calls in there for $1.35. Way away from my strike right now. It's trading probably around a little bit less than $1. I probably could have gotten that when we rallied up a little bit higher, but I missed that opportunity. Got out of the DC90 calls and then decided when the market started coming back, of course, thought I should be rolling these up and out. Why didn't I think of that earlier and just roll those trades? But, you know, it is what it is. At the end of the day, I still got a working order in there, and I'm going to continue to try and lower my overall cost basis on that trade there. And I think that's about it. Nothing to see here in 22nd Century other than a sell-off down to $2.10. That market I talked about, you know, this was a very bearish signal. I'm going to hold on to these because I'm holding on to it for a long haul. I'm in it very small, so I'm not too concerned. Touching the 9-day simple moving average, still showing long or short-term bullishness. But basically, if we get down into around this dollar area is where I'm going to become very interested in looking to buy some of this again. Again, very small. I'm not going to go in full boat on this, but starting to see some weakness here across the board in 22nd Century. That's probably happening within the very recent area, and that could be because right before I went on, I did see, I think it was maybe Philip Morris or something, was talking about people are going away from the smokeless and actually getting back to the fume, I think is what that guy called it, but basically real cigarettes, where people are starting to kind of migrate back towards that. I'm not sure why, but that being said, maybe that's part of this catalyst for the sell-off. I'm not too concerned. I think that this company has got some upside potential, and like I said, it's the mad money. It's something I'm willing to hold on to for a little bit, or more of a long-term duration. All right, that's it. Hope you guys all enjoyed this. One last thing, make sure you have a moment to go over our site disclaimer, as we are an educational company. I'm not trying to solicit you guys to buy or sell any of this stuff. What I'm trying to do is educate you guys on the optimal way to trade options. Okay, that's it. If you can't take that, take it easy.